Hello and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, June 30th, and I'm recording this from my office in Purchase, New York. U.S. stock indices have hit new all-time highs with the S&P 500 up 5% year-to-date. Markets seem to have moved on from lingering uncertainty on geopolitics, tariffs, and economic slowing to instead focus on profit growth that could come in 2026, accelerated by corporate tax cuts, Fed easing, and anticipated deregulation. Further energizing momentum is a reemergence of what we would call animal spirits and the dreamy visions around the next wave of innovation in areas like robotics and autonomous vehicles. Notably, the recent rally has come even as valuations are extremely rich and CEO confidence remains low, while economic data like retail sales and ISM readings are currently disappointing. While we can appreciate the powerful appeal of the emerging bull case, our enthusiasm remains measured. A deeper analysis of policy implications indicates there's likely to be wide dispersion between the winners and the losers, a backdrop that supports a more active stock-picking oriented approach. Consider first the likely tax bill, which is emerging from the latest round of Senate revision. Elements of corporate sector stimulus include provisions around expensing R&D, the depreciation of CapEx, as well as additional leeway on interest expense deduction. These factors can certainly help boost earnings, improve cash flow in investment-intensive industries, and reduce effective corporate tax rates. Our MS&Co analysts estimate that net stimulus from tax advantages could add roughly 50 basis points to GDP in 2026. That said, as positive as this may be for key companies, the aggregate gains would almost be fully offset by 2027 when the so-called pay-fors kick in. This could create headwinds to consumer spending, clean energy, and Medicaid-related health care. Overall, the impact of the bill at best is likely to be additive to U.S. debt, with annual deficits continuing to run at about 6% of GDP through 2035. The point is that this bill will create a mosaic of winners and losers, as opposed to the broad stimulus impacts of the initial 2017 TCJA. Second, capital markets deregulation is also likely to be a double-edged sword. Consider work that's being done to reduce the capital requirements of the global systemically important banks. Lower balance sheet reserves should free up capacity for things like bank lending, investment, and shareholder buybacks, a positive for the mega-cap banks. That said, loosening these restrictions will likely intensify competition in credit-linked businesses where key segments, especially in private credit, are already facing declining returns. Also, recently advanced stablecoin legislation is raising the possibility for an entirely new and disruptive business model for cash payments and payroll processing. So as we think about current market dynamics, now is not the time to be purely starry-eyed. There's good money to be made, but you've got to be a stock picker. Consider stocks with the potential for upside surprise in earnings and cash flow, like select tech names and others in financials, industrials, energy, and parts of healthcare that are the policy beneficiaries. Avoid the overhyped themes and look to complement these positions with diversification in international equities, commodities, energy infrastructure, and hedge funds. Thanks, as always, for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.